Hello, it's Brian Shannon from AlphaTrends.net. Today is Tuesday, the 21st of October, 2008, and the global liquidation of anything with an electronic bid seems to continue here. The S&P 500 was down $3.43 or 3.47% today. You can see here on this daily time frame that we're not really adding to the bounce. We've got lower highs and we've got higher lows. So a lot of people have been observing that it looks like we're maybe forming a bearish triangle here. A triangle, being a continuation pattern, it typically resolves in the direction of the primary trend, which of course is obviously lower here. So yesterday we saw that the market had rallied, but the reason for concern was the lower volume. And again, today we had pretty light volume in here. So we're getting a lot of mixed signals on different time frames, and really on the intraday time frames, it's really choppy in here. We've had some resistance here the last couple days at this 98.60 or so, and it was looking like maybe the market was going to get back above that here this afternoon if it could get above. Well, we were looking at the Qs, so we'll look at that in a moment. But here, let's look at that 1 minute time frame. You can see what a choppy session it was. In this VWAP, we had held for a little bit early on today. The market kind of distributed in here and then broke down hard, recaptured that daily VWAP, but then when it made the inability to make a new high, and then it made a lower low right here, that's when once again the floodgates opened here in the last half hour, 45 minutes of the day. So the S&P 500, again, we remain in a primary downtrend. This longer term trend line here and then this trend line remain intact, so we can't really look at that as really being significant anymore. The most significant resistance is right here at about this 90, let's just call it 98.70 to be a little bit more conservative. Yesterday I'd said the more important level of support was going to, should be found down near the 93.70 level, and that's right around these lows from Monday morning, right in here. We also see this little level of support forming right here at about 95.50, and we've got this market, going back and forth above and below this 5-day moving average, and that's not providing us with any direction. What we need to do, realistically, I think, is break this range for the next bigger move. If it can get above and hold above this, let's just even call it 90. If it can get and hold above about 99, then perhaps we're going to see a little bit of a continuation and perhaps go back up and test these levels right here. That's the least likely scenario in my opinion, because we are in a primary downtrend, and as I said earlier on the blog today, when you have mixed messages on different time frames, defer to the larger time frame and realize that catching a rally in a bear market is something that that I've been trying to do, and I've done in here, but not every single time that I've tried. It's a very risky way to make money. The appeal is obviously the magnitude of these rallies is so large, but we're losing velocity in here. In my book I talk about a ball that drops from the 14th floor, rally, bounces up to the 10th floor, comes back down, rallies up to maybe the 8th floor, and the momentum kind of leaves the market as less participants are involved. And this low volume says there's just a lot of people sitting on the sidelines in here maybe waiting it out. The path of least resistance remains lower, so I think risks remain very large, and I'm going to continue to emphasize that. If you don't like hearing it, then don't listen to these videos, because risk management is job number one, and I repeat myself over and over again on that, and I've been saying that for years as well. It's not a new thing, and it's something that you really have to respect. When I look at the 2-minute time frames and the 1-minute time frames, I might be talking about a rally developing, but you better believe as soon as it starts showing signs of breaking back down, that call is no longer something that I'm interested in, that the market is breaking down, and you have to respect the risk and listen to price first and foremost. The Russell 2000 was down 2.76% today. It lost $1.50, and we've got the same kind of tightening of range in here. Same thing here with the lighter volume as well. So these low volume events typically lead to something bigger coming around the corner, and with all the trends lower, it's hard to it's hard to imagine imagine that we're going to break higher, but of course we always have to be prepared for anything, and temper our expectations so we'll never be truly surprised by what the market action dictates. If you're betting on Apple earnings, I hope it works well for you, but you're just betting, and there's very little risk. There's a lot of risk in that. It's not worth the risk, is what I meant to say. The important level of support I was talking about yesterday in the Russell 2000 is at 52. I think that continues to be the more important level right now. We've got this little pattern of lower highs in here on the 30-minute and on the 10-minute time frame. So we can look at that, and you can look at these trend lines. And yesterday I said, breaking a trend line doesn't mean that the market's going to reverse. All it means is that the rate of descent has slowed, and stocks correct either through price or through time. Right in here, though, again, breaking 52, then I think we're in for bigger trouble on the downside. Perhaps this trend line will catch it if it drops back down. So, if we get a break below 52, I would draw that in and see if that holds as support. If buyers are found in that area here over the next day or two. It wouldn't be a place to look to buy the market or to cover your shorts. It's just a potential level of support that you want to be aware of, just in case. That way maybe you want to cover your shorts once the evidence is shown that buyers do show up, if they do show up in that area. It's not a way that you should trade. Gold was lower as well, down $2.47 on the GLD. We've got that declining 50-day moving average. We've got lower highs and lower, almost lower. Well, here in the daily time frame, we broke that low, obviously. And that's what's led to this most recent sell-off. But here on the weekly time frame, we've got these lower highs, we've got these lower lows, and right now it looks as though the market should head down to create another lower low in here. So gold remains in trouble. Oil obviously continues down as well. The USO was down $3.03, and as I said, I think that this area 55 to 60 probably ought to be where the market tries to establish support, but the bottom is a process. It's not an event. A sideways market isn't a reason to buy just because it stops going down, because they typically, if they don't scare you out on the way down, they'll wear you out as the stock, as the market, whatever the market is you're looking at, corrects through time as well. So oil finding resistance still at that declining 5-day moving average, and that's really kept this market captive since late September here. So for the entire month, basically. Let's take a look at the financials. The financials were down 46 cents or 2.8%. They're still obviously looking very bearish. The biggest level of potential resistance still lies between the $17 and $18 level. The market will have to clear that before you can have any kind of confidence in buying these financials. And right now, it looks like we're more in danger of a breakdown than any type of recovery. We've got a little bit of resistance as well on the shorter term time frames at about $16.40, and the more important level of support, as I said yesterday, it was about $15.25. Breaking below $15.25 then brings this level here at about 14.5 into play, and then of course we've got the lows. So we've got a declining 5-day moving average. It says the sellers are still in control here, and no reason to be involved on the long side. You're playing a very dangerous game if you are. Same goes with the Nasdaq 100. The Qs, this group was down 5.1% today, so leading the way lower on a percentage basis once again. And we've got it was down $1.72. Here we see big red candle in here. What happened late in the day was that we had taken out what was starting to be support from this week, which was Monday's lows, and then we tested that early in the morning, started to bounce from there. We've got a declining 5-day moving average on the 1-minute time frame. I was looking right in here saying if the market can test this VWAP and then hold, maybe there would be a rally, but instead it made a lower high and then confirmed that with a lower low right in here, and then once again the floodgates were open and the sellers all rushed in all at once. It looks as though with this pattern of lower highs and now this new this little level of support broken, that we're headed back down, maybe even to the lows. So it remains a very, very, very dangerous market to be playing on the long side, and you've got to be quick and disciplined, otherwise you're going to get hurt real badly.